I'm Doris and I'm here to show you about my market update. While Deutsche Bank beats the next Credit Suisse, anyone who has been through 2008 will be alert. Dollar demand is soaring. Central banks reduced their debt holdings at the fastest pace in 9 years. With the aftershocks in the US and Europe, the latest focus is Deutsche Bank, Germany's largest bank and one of the world's leading financial institutions. Wednesday, it fell by 15% at one point, marking the biggest intraday decline since March 2020. The stock has fallen for 3 consecutive days to a 5-month low, and has lost its market value by a fifth since March. Today came after S&P Global data showed Deutsche Bank credit default swaps jumped above 220 basis points from 142 basis points on February 22nd, the highest level since the end of 2018. Chen Hao, CEO of Angel Asset Management, who experienced the 2008 global financial crisis, told China Business News that his trading team was informed on Monday to focus on U.S. regional banks and several European banks, including the Deutsche Bank, in anticipation of new explosions in the banking sector. The problems exposed in the financial system is the time may not be that simple. In the face of the Credit Suisse crisis, the Swiss government had to amend the law and conclude a merger at the expense of creditors. The attitude and pace of the situation were extremely difficult, and anyone who had experienced the Lehman incident in 2008 would be so alert, he said. Deutsche Bank's default risk has risen sharply. The Deutsche Bank CDS also posted the biggest one-day gain on record, according to financial data firm Luford. Chen Hao analysis. CDS is a credit derivative. It is a contract. When target money has a repayment risk, the investor can buy CDS and pay a certain fee and enter the contract. Once the target company really defaults, the investor can be compensated according to the content of the contract. By this logic, when the risk of default at the target company rises, the CDS price also rises. Both German government and European Central Bank have tried to calm market sentiment. German Chancellor Scholz said, "There is no reason to worry about the Deutsche Bank. Deutsche Bank has modernized and restructured its business model, and is a lucrative bank," said Scholz. European Central Bank President Christine Lagarde also told European leaders that the Eurozone banks are well capitalized and liquid, resilient under strong regulation, and will inject liquidity if necessary. However, urgent comments from the German government and the European Central Bank failed to stop a broad decline in European financial stocks on Friday, with Commerzbank closing down 5.5%, Societe Generale down 6.1%, and Barclays down 3.8%. A bigger storm? Over the past 2 weeks, the explosion of European and American banks have caught them surprise. Silicon Valley Bank, the 16th American bank, fell 2 days after falling 60%, and shares of the Credit Suisse, the century-large Swiss bank, plunged 24% on Friday, and was forced to sell after 4 days. 24. Deutsche Bank relay shares plunged less than a week before the exit of Credit Suisse. Concerns about widespread contagion in the financial system have made more banks the next domino. Chen Hao further explained that although the size of the U.S. regional banks is small, it is large. Due to the huge Fed interest rate hike, the balance sheets for most of the regional banks are under great pressure. On the other hand, the European banking system is also quite fragile. It is not clear whether there will be a systemic risk in grade 2008. The U.S. regional bank collapse, UBS Credit Suisse merger, AT1 subprime debt was zero, as investors or do not blindly bet. Investors are advised to wait for the opportunity to reduce positions, leave for more cash for a rainy day, said Chen Hao. Lin Zhen, head of U.S. interest rate strategy at Bank of Montreal, told China Business News that anxiety from the Americas is complicating the work of regulators and policymakers. There is no doubt that the European authorities have the same concerns as Fed Chairman Colin Powell and Treasury Secretary Janet Yellen, that the situation is more severe than expected. It is too early to say that industry turmoil is over. Moody's Investor Service said the risk of banking problems spread to the broader economic sector or rising. The longer the financial conditions continue to tighten, the greater risk that the pressure will spread outside the banking sector and cause greater financial and economic losses than our underlying scenario. Dollar demand is soaring. The Fed's use of overseas liquidity tools also surged, with the FIMA repurchase agreement tool reaching a record $60 billion, far surpassing the $1.4 billion peak at the peak of the pandemic. As the banking crisis spread and global demand for dollars surged, central banks quickly reduced their holdings to cash out, including the use of Fed's overseas liquidity tools. Foreign official holdings of U.S. Treasury bonds fell by $76 billion to $2.86 trillion in the week ended March 22nd, the biggest weekly drop since March 2014, Fed's data showed. Meanwhile, the Fed's Foreign and International Monetary Authority (FIMA) repurchase agreement was reached a record of $60 billion, well above the $1.4 billion peak at the peak of the outbreak. The FIMA's repurchase agreement facility was launched on 2020 March 31st, aiming to support liquidity in global financial markets and mitigate the impact of the pandemic on the global economy. The tool allows foreign central banks and international organizations to use their holdings of U.S. Treasury bonds as collateral to ask the Fed for dollar liquidity to ease funding pressure. In response to the surging FIMA repayment tool usage, Barclays strategist Joseph Abate was quoted as saying, "Given the dollar financing rate, we feel that the lending is precautionary. It is worth noting that only a small portion of the 136 billion foreign officials raised from the sale of Treasury and FIMA buybacks flow back directly into the Fed's balance sheet or broader custodian plans. As of March 22nd, the balance of the foreign reverse repos pool increased by only $3 billion, while the Fed's managed institutional securities, including mortgage-backed securities, only increased by $7 billion. The Letters Bond Market Research Corporation analysis said, the phenomenon suggests that most of the cash raised by central banks may have entered the private market. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.